All right, welcome everyone. Today we're diving deep into something that's totally rewriting the playbook for institutional crypto, artificial intelligence. We're going to get into the nitty-gritty, the actual tools, the super advanced strategies, and all the messy real-world stuff that's shaping this new frontier.
So, let's just kick things off with a pretty staggering number. 70%. Yeah, that's right. An estimated 70% of institutional crypto trading strategies are now using AI in some form. Look, this isn't some passing fad. It's the new standard. It's the baseline for even being competitive. The takeaway is simple. If you're not using AI, you are already falling behind.
So, here's how we're going to break this down. First up, we'll talk about why AI isn't just a nice-to-have anymore. It's absolutely essential for finding that alpha. Then, we'll crack open the institutional toolkit and see exactly how they're analyzing on-chain and sentiment data. After that, we'll get into how these models deal with the real world, all the chaos of geopolitics and regulation. And to wrap it up, we'll zoom out and look at the future. What's on the horizon with things like quantum computing and tokenized assets. Okay, let's jump right into part one. We're going to unpack this major shift. How AI went from being this, cool luxury item to an absolute must-have tool for survival in a market that is just drowning in data and moving at light speed.
First, you just have to appreciate the sheer scale of the challenge here. We're talking about a $2.5 trillion market. It never sleeps, it's 24/7, and it's got over $150 billion in volume every single day. A human brain or even a team of human brains just can't keep up. It's impossible. You're going to be too slow, and you're going to miss those tiny, split-second signals that ultimately make or break a trade.
In this environment, this is exactly where AI shines. It just eats up these massive, messy data sets in real time. It finds patterns that no human could ever spot. And it's not static. It adapts its strategies on the fly as the market moves. But maybe most importantly, it's your best line of defense. It's constantly scanning for anomalies and managing risk at a level that, honestly, is way beyond what any human can do.
Okay, so what's actually in this institutional AI toolkit? Let's get specific, right? We're going to pull back the curtain and see how all that raw on-chain data, plus all the constant noise from social media and news, gets turned into actual actionable trading intelligence. So, you've got a couple of heavy hitters here, and they offer two really different but critical perspectives. On one hand, you have platforms like Glassnode. Think of them as giving you the fundamental health of the network, kind of like the market's vital signs. Then you have something like Nansen, which uses AI to do something very different. It tracks the smart money. It follows the wallets of major players to see what they're doing. And here's the key. Institutions don't pick one or the other. They need both of these views to really understand what's going on.
And this is a fantastic real-world example of how this all comes together in a workflow. So, step one, the AI model flags that some very large wallets are starting to accumulate a specific asset. But it doesn't just stop there. Step two, it checks for outflows from exchanges. Why? To make sure these guys are actually planning to hold, moving their coins to cold storage, and not just shuffling things around before sale. Then step three, it uses natural language processing to scan social media, news, everything to see if sentiment is turning bullish. And only when all of those separate signals line up, does the system even consider executing a trade.
And that last piece, the sentiment piece, is so unbelievably important. Just look at this. Research suggests that a whopping 60% of short-term price moves in crypto are driven by, vibes, pure market sentiment. And that's exactly why natural language processing, or NLP, has become such a game changer. These are AI models that can actually understand human language, and they're sifting through millions of tweets, posts, and articles to put a real number on the market's mood.
We've talked a lot about offense, finding alpha, but AI is just as critical for defense. It's a non-negotiable risk management tool. For instance, these models can spot weird on-chain activity that might be the first sign of a DeFi exploit. Think about that recent event that put over $16 billion of Aave's deposits at risk. Catching those signals just minutes or even seconds earlier is the difference between a small problem and a complete disaster.
Right, so it's one thing to have these incredibly powerful AI models, but they don't operate in some clean, sterile lab. No, they have to work in the real world. And the real world is messy, it's unpredictable, it's packed with geopolitical drama and a regulatory landscape that changes by the day.
So for an AI model to actually be effective, it needs to be fed a constant stream of this real-world data. It has to be able to weigh all these different signals. Things like, okay, Brent crude oil just spiked over $104 a barrel. That's a classic risk-off bearish signal. But at the same time, it's seeing over $1.5 billion pouring into the new Bitcoin ETFs. That's incredibly bullish. It's this continuous high-stakes balancing act, 24/7.
And this quote, this one from Alexander Grieve at Paradigm, it just perfectly captures the political mess these models have to deal with. He's talking about the Clarity Act, which is a really big deal for US crypto regulation. The political battle around it is intense, and that creates this massive cloud of uncertainty that directly impacts any trading strategy. And look at this chart. It puts that uncertainty into hard numbers. Just a couple of months ago, in February, the odds of the Clarity Act passing were seen as 82%, a near lock. Today, it's down to 48%. It's a coin toss. And if you're an AI model, this forces a complete reevaluation of any strategy that relies on stablecoin yields, because that's exactly what this bill is aimed at. What looked like a sure thing is now anyone's guess.
And hey, this isn't just a US thing, not by a long shot. You're seeing other major hubs like Japan tightening their own rules, getting much stricter on things like insider trading. So what does that mean? It means these institutional AI models have to be constantly learning and adapting. They're not just being recalibrated for market shifts, but for this incredibly complex, tangled web of global regulations. Okay, for our last section, let's zoom way out. Let's look at the long-term horizon, because institutions are using AI to navigate a future that has these two massive opposing forces. On one side, you have potentially existential threats, and on the other, you have game-changing opportunities that are already starting to pop up. So deep down, at the very core of Bitcoin security, is an algorithm called ECDSA. The simplest way to think about it is like the cryptographic lock or the digital signature that protects every single private key and authorizes every transaction. It's the proof that you own what you own, without ever showing your secret key. And against any computer that exists today, it is practically unbreakable.
But what if a key existed that could break any lock? And that's the whole question, right? This is where the long-term threat of quantum computing comes into play. The theory is that a powerful enough quantum computer could do the impossible. It could essentially break that lock and derive a private key just from a public one.
Now, before anyone panics, let's be super clear. This is not happening tomorrow. Not even close. The quantum computers we have now are under 1,000 qubits. To actually pose a threat to Bitcoin security, experts think you'd need a stable machine with over 1 million qubits. So the good news is the industry has a runway, probably about 10 to 20 years, to upgrade everything to new quantum-resistant algorithms.
So yeah, quantum is this big storm cloud way off on the horizon. But the opportunity of tokenized assets, that's happening right here, right now. Just look at tokenized US treasuries. We're talking about real US government bonds living on the blockchain. That market has already exploded past $14 billion. This isn't some future prediction. This is real institutional money moving today.
And this really gets to the heart of the dual challenge facing institutions. They have to use AI for two completely different things at the same time. On one hand, they're modeling these long-term, far-off risks like quantum security. And on the other hand, they're trying to capitalize on the explosive, near-term growth of putting real-world assets on chain. It's a real balancing act.
So, this all leaves us with one last big question to think about. As AI gets better and better at crunching the data and automating all the strategies, what's left for human intuition? What's the role of the human trader? Maybe, just maybe, in a world completely dominated by algorithms, the real edge, the new alpha, becomes the one thing that AI can't replicate, and that's human judgment.
Thank you for watching this video. Please subscribe this channel.